Welcome to This Week in Money. I'm Jim Goddard. Today, Bob Hoye from chartsandmarkets.com runs down the major markets. They could be best described as choppy, with commodities giving hints of action seen before major corrections in 2008 and 2011. InsideTrackTrading.com President Eric Haddock examines the cycles he's noticed in the stock markets, silver, gold, interest rates, and Bitcoin. Publisher of Merriman Market Analyst, Ray Merriman, looks at Geo-Cosmic events that appear to influence the financial markets and politics. He says reading the relationship between the sun, moon, earth, and other planets has been amazingly accurate. Plus, at the end of the show, we'll have a company showcase update from American Manganese CTO Zarko Meseldzija. We'll talk to Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to This Week in Money, Bob.
Yeah, hi, Jim. Good to be with you. And it's been a fascinating week in the markets, particularly the stock market. It became, just looking at here now, kind of choppy during the week, up and down, some pretty big bars, and then as it kind of went into a weaker close. So, and it didn't look like anybody tried to prop up the market and make a fake stronger close. So we'll just watch and see what's happening here. But on the, like for example, on the S&P, a month ago we got what we call a springboard buy. And this model is designed to identify the buying opportunity on each of the dips that you get, and it's designed to work in a rising to flat market trend. And of course, what I always joke to myself, Jim, is that when you're in a mature stock market like this one is, and parts of it are absolutely crazy, you can't tell the last springboard buy ahead of time. You have to wait for the market to take out that low. So this is what happened late in November. That low was taken out, and then the market became kind of oversold enough that it bounced back up again. So it looks like it's testing the high. And I think what one can say about the action during the week, choppy, up and down, as I said, with some pretty big bars, and then on Friday, late in the day, weakening. So, and with that, you had the bond future, the U.S. bond future, long treasuries or Canadian long bonds, rallied with that because if we go into a correction in the stock market, you can get they call it the flight to quality trade, whereby the hot money will flow over into the bond future. But actually, if you're in a troubled financial market, the really careful money goes to the most liquid items, which is U.S. Treasury bills and or gold. And so you can't really call the flight to the long bond, which can be speculative at times, as a flight to quality. Flight to Treasury bills is the flight to quality. Flight to the bonds is just could be a good trade coming up out there. Then other thing is that the long bond future has been depressed because of all of the stories about price inflation out there, that the 1970s type of CPI price inflation is going to come back. And the story is well into the market. They've been talking about this for more than a year. And even one name hedge fund guy in the States has gone on and said that it's going to be worse than the 1970s inflation. It's going to be another example of the Weimar inflation that destroyed Germany in 1922 and 23. So, but I think my approach is the best is if you have a lot of financial history, you can see the patterns. And in this case, we had a big commodity high in 2008 and 2011, and then the Federal Reserve got concerned about not enough inflation, so it eased the money markets. And, of course, it's the public that decides what will be speculated in. And they chose to speculate in stocks and bonds. And this was also, if you go back to the 1920s, you had a huge boom in commodities in 1920. And when they crashed, it scared the hell out of the Fed. So they spent the 1920s saying there's not enough inflation and we got to put more credit into the system, not knowing that it was feeding inflation in financial assets, stocks and bonds. And so, as you know, Jim, and our history is extensive, and the first great financial stock bubble was the South Sea bubble in 1720, and it was preceded by the same thing, a war, high commodities, and then that crashed, and then out of the ashes became speculation in stocks and bonds. So here's the pattern. After every great financial mania, and this, what we've been in for the last couple of years, is definitely the greatest financial mania in all of history. When it fails, then you end up with a post-bubble contraction, whereby all hyperinflated asset prices come down. So those pundits out there who are looking for 1970s type of inflation to come back, I don't think it will. The big game truly is inflation in financial assets. You've got, for example, the German 10-year note has been trading into a minus territory in nominal yields, and that's never happened before in history. And then on the stock side, the Bitcoin side has had huge market capitalization, like they are big stocks, making percent gains that have never been happened before in the past. Like in the South Sea bubble, the key company was a quasi-government company called the South Sea Company, and that was a 10 times gain in a year and a half, and then in another 8 months it was all the way back down to £100. So whereas the gains in the cryptos and the bitcoins have been staggering, absolutely staggering. So it's safe to say that the big play has been in financial assets, and in which case that will be the dominating force when it comes apart. The financial assets can't go straight up forever. Eventually they exhaust themselves. And we follow this, and we're watching for further symptoms of this market. We've got all the symptoms in of excessive speculation. What you're looking for now is when it starts to fail. And with some sad stories coming out of China with some major development companies, property development companies in serious problems with either the principals or the families taking, 80 and 90% declines in their stock positions. That sounds like a contraction to me. So, Jim, it's been an interesting week.
Bob, thank you so much for chatting with us.
Yep, at any time, and we look forward to the next one, and you have a good weekend now.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Coming up, Eric Haddock next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. I'm speaking with Eric Haddock, CEO and President of InsideTrackTrading.com. Welcome back to the show, Eric.
Well, thanks for having me back, Jim. It's my pleasure.
Eric, a big move for you from the Chicago area to Central California. Goodbye, winter. Hello, wildfires.
Well, we're hoping that we can keep the wildfires at bay, but yes, I am in the process of relocating. Most of it is behind me, but as you probably know if you've ever dealt with it, there still are plenty of details and transitional things to work out. But yes, it will be a bit calmer winters, I'm assuming, or at least a bit milder winters. That I can pretty much bank on.
Yeah, and hopefully no more tornadoes coming in off the lake.
Hopefully.
Yeah. Chicago, I just remember I was watching a Cubs game where people were told to take cover under the stands as you could see the tornadoes in the distance. I think that would be kind of a chilling sight. Eric, now, speaking of chilling, or was it the Fed held a meeting midweek? Did they tell us anything we didn't know, or was it a case of what they didn't tell us?
I think it was about 95% telling the market what it already knew. I think one of the things that they're making a big deal about is that the Fed finally dropped the word transitory when describing inflation, which probably means that inflation is getting near its peak and that it may turn out to have actually been transitory. You know, once all that pressure builds up and a fundamental validation finally occurs, that's usually near the end of a cycle. But I even, with regard to things like the dollar, which I know we can talk about in a few minutes, but I titled my recent intra-week alert, Buy the Rumor, Sell the Fed. And that even the dollar has been, and interest rates have been held up on anticipation of that Fed meeting. And the market got pretty much what it expected. And as is almost always the case in the markets, once you get all that news, there's nothing left to drive the market higher in that particular cycle. And so the dollar was holding up into the Fed meeting, and it got the news it expected that, you know, on the horizon we'd see interest rates, allegedly 3 next year and maybe 2 the following year. And in theory, that should be bullish for the dollar. But that was it. That was the last bit of bullish news for this cycle within the dollar. And so, we get a spike high on the initial news, and then all of a sudden it starts to, pull back. And conversely, at the same time, you get gold and silver, which had been under pressure because higher interest rates are a drag on precious metals. Now that you've got the culmination of that expectation, gold retested its support, same with silver. I've been watching 1760 in gold, 2150 in silver. They both spiked down to that and immediately started to rally, and I actually expect this rally to have some legs. So for the most part, the Fed told the markets what they expected, and now the market starts to turn its focus. It's like, you know, as if it had this big individual jumping up and down and waving its arms in front of it. Now that individual has moved to the side, and the markets will start to look ahead a month, 2 months, 3 months down the road, and start to factor in those expectations into pricing.
U.S. employment numbers, pretty well what were expected, or unemployment numbers. Does that factor in, and where does that place? I know you look at cycle, short, medium, and long term.
First of all, looking at what the Fed is doing and its interest rates, was that predictable? And what do you say from looking at your cycles?
Well, I don't know if week to week or even month to month variations in the employment rate are very predictable from a cyclic and technical perspective, although there are times when the bonds and notes and shorter term interest rate vehicles, when they have very convincing and synergistic cycles coming into play, and along with price action and certain technical indicators, if they've given me a high level of confidence that they're about to do something, either bottom or peak, or break out into a strong uptrend or downtrend, and we're coming into a monthly employment number, then I will kind of put out there to my readers and say, okay, this is what I've been anticipating, this is what I expect, and it certainly is continuing to set up, leading right into this employment number. So my conclusion would be either the number itself is going to be a surprise to that direction, or the trader's perception of it is going to be a surprise, kind of like the Fed news yesterday, that your market novices would look at that and say, oh my gosh, the Fed just came out and talked about all these interest rate hikes and all this. That should, the dollar should be running higher, interest rates should be surging, not realizing that it's already baked in. And so sometimes those numbers will be a little more predictable from that perspective, but I don't really spend much time trying to analyze each month's or each week's jobless claims and unemployment numbers. I'll let the experts on those particular things do that, because very often the market will have some reason to react differently than what, even when the economists get those numbers perfect, the markets react differently based on a whole set of additional variables.
Interest rates. I remember when they peaked back in 1981 because inflation was running so high, we even got a cost of living bonus on our paychecks every 3 months. I happened to work for a very forward-thinking employer. Of course, they sold their radio station to a big corporation who didn't believe that employees should have inflation protection, and there went our bonuses. But also, Canada's savings bonds in 1981 paid 21%. Are we ever going to see interest rates like that again? Are they more sensitive to that balancing act between when you have rampant inflation, using interest rates to slow it down or kill it?
Yeah, I don't think you could, barring some extreme circumstance that there would already be enough other problems to worry about, I wouldn't see anything even close to that again, because of what it would do to the stock market, to the economy, and because the stock market and the economy, well, stock market in particular, react so violently and so quickly to things like that, excuse me, you could get, initial couple of bumps up in interest rates that, let's say they're a surprise. They're more than what was expected. And the market will often, within weeks, just be plunging on news like that. And then next thing you know, all of a sudden, commodities are being dragged down with it. And then down the road, you've got the employment drag coming as a result of that, that just like we've seen over the last couple of years with what the Fed's been doing, that just when they think they're in a position to start letting rates bottom and start bumping them up, all of a sudden something else comes out of left field, and all of a sudden those rates are being held artificially low. So, I would doubt, barring some extreme situation that we probably couldn't even anticipate at this time, that we wouldn't see things like that again.
So, taking a look at that, is there any way for you to predict what kind of interest rates we're going to get or inflation using cycles, or is this, again, a transitory thing that don't really show up in the long-term cycles?
Oh, no, they definitely do. And as far as the extent of how far they would go, as much as it is correlated to those other markets I mentioned, the 30-year bonds, 10-year notes, 2-year notes, Eurodollars, as much as there's a direct correlation between them, and often those markets I just mentioned anticipate things and often over-anticipate things, as the markets do, then yes, there is definitely cycles and technical indicators that are very consistent. And I know that I've even talked with you about this going back over the last couple of years, where, for instance, the bond market has a very consistent 4-year cycle that dates back 30 years. And the most recent occurrences had timed multi-year peaks in the middle of 2012, right around July of 2012. Then there was another peak, and just for any listener that may not quickly catch this in their mind, those peaks in the bond market equate to lows in interest rates since they're inversely correlated. But there was another peak 4 years later in July of 2016, and that 4-year cycle had, like I said, that had gone back into the 90s, so it was something I had a very high confidence level in, as well as many corroborating cycles and technical indicators. So coming into mid-2020, I explained why I thought we should see a major bottom in interest rates and top in the bond market right in that same July time frame. And that was exactly when bonds peaked and interest rates, even though they didn't turn up at the time, that was where they bottomed out. And looking ahead, there's two primary things that you can usually deduce from a cycle like that. One is that I would expect another peak in bonds and low in interest rates out around mid-2024. But in between, you would usually get a move down in bonds and up in interest rates for more than half of that cycle. So in the textbook scenario, what I would expect is you see this low in interest rates and high in bonds in mid-2020. Then you see a move up in interest rates and down in bonds into at least late 2022, maybe early 2023. And then you get kind of a reactive pullback in interest rates and bounce in bonds. But because of how the sequence of cycle highs in the bonds has gone, and I hope I'm not confusing or losing any listeners here, I do illustrate it in many diagrams that I've included in my newsletter and whatnot. It's a little bit easier when you can see some diagrams in front of you. But if bonds rebound into mid-2024 and set a lower peak at that time, that would be the most likely scenario for this 4-year cycle. So from the inverse interest rate perspective, it anticipated a bottom in mid-2020, a move up in interest rates for 2.5 to 3 years, so into late 2022, early 2023, and then a pullback in those interest rates into mid-2024 before you get ready for a whole additional cycle. Well, everything I've just described, I was describing in late 2019, early 2020, and explaining how that 4-year cycle works, what the likely scenario is, and what I just described is what the Fed has now been describing for interest rates over the last few months. So you often get the fundamentals, or at least in this case, the anticipated fundamentals, kicking in about a third of a way into a cycle. That's why I prefer cycles and technicals, because the key difference is they give you timing. And so once the fundamentals start to kick in, the market's already moved. And so bonds were anticipating this top and this 2 to 3 year sell-off, that's already been evolving for over a year. Now, there's many swings within that overall decline that you then use weekly and daily technicals and cycles to hone down your specific turning points and whatnot. But the overall expectation has been confirmed by a lot of what's been going on with inflation, with the economy, and so as of right now, it seems to be on track, and that's what I anticipate for the coming 1 to 2 year period.
People are wondering, what's the future of the stock market? What do the cycles tell us?
There has been, well, there's actually been a few, but one uncanny cycle that I have described many times in my publications, and again, I lay it out with more diagrams and illustrations so that traders can digest it and internalize it a bit more. But it has been a consistent 16-month cycle. That another thing that you'd have to see in my illustrations to really grasp, that I treat cycles as an evolving tool that specific cycles will impact lows in a market, so they will be the timing of intervals, of low intervals in a market, and then when they hit a certain time within a trend, they will then invert, and a cycle will time a breakout move, and then it will start to time successive highs. And the way I illustrate this with one of my key cycle tools is with a sine wave type of pattern, and you've got the zero line, the equilibrium point, and as that sine wave is oscillating below the zero line, you usually get, in a textbook scenario, and obviously the market is never perfectly textbook, but in the ideal scenario, you would get a succession of 4 lows at this specific interval, and then you would get a breakout to the upside and you get a succession of 4 highs. With that said, this particular cycle that I'm talking about has been a 16-month cycle in the equity markets, and it timed a succession of lows like I talked about back in the early 20-teens, and then it, early to mid-20-teens I should say, and then it broke out to the high level, broke through that equilibrium point, and it timed right on schedule a very significant peak in September, October of 2018. Following that, you got a very sharp sell-off into the end of the year. And coming into 2020, I was describing in everywhere I could why traders should be looking for another significant top in January, February of 2020, which was 16 months from that October 2018 time frame, and a sharp sell-off after that. And sure enough, we got that. And then 16 months forward from that was when I described why I thought we would see a topping process begin, and that was in May, June of this year. And if you look at many of the primary indexes, except for the Dow, S&P, and NASDAQ, the ones that are in the headlines, so they need to keep them propped up as well as possible. A lot of other indexes and many stocks set their peaks in May and June of this year, and that 16-month cycle has also broken down into very consistent 8-month cycles, where I described why I thought that you would see in the stronger indexes, you'd see a succession of higher highs at those 8-month intervals, leading into a more significant peak out farther in 2022. But this 8-month midpoint cycle comes into play in January and February of 2022, in the next month, 1 to 2 months. And it coincides with a very consistent 2-year cycle where we've seen peaks in the January-February time frame and then substantial sell-offs. It coincides with a lot of price timing indicators that are now showing key indexes have reached extreme levels to the upside. So they're living on borrowed time. So all these things are corroborating this outlook that we would see a final, and when I say final, I mean on like a 6 to 12 month basis or 6 to 12 month trend, a final peak in those equity markets in the beginning of next year, and then we'd be in a position to see a more substantial sell-off. But that's all part of an even larger topping phase that I think we have evolving.
Crude oil has enjoyed high prices going into December, down now, but will that continue?
I think that the energy markets have one more leg up here, and for 2 years, one of the markets, natural gas that I've talked about, I've been focused on the first quarter of 2022 for a final high. It had a big run up into about a month and a half ago. It's had a big correction since then, but there's still, as long as it holds key support around 350 to 370, natural gas would remain in a position to head back up into probably February of 2022, and crude, unleaded gas, and heating oil have related cycles that also are next peaking. They recently peaked in late October, and the next expected peak is in late February, early March. So I think that we are in another upcycle. It doesn't mean that it goes straight up. In fact, all that distinguishes is that near that cycle high, we should see a spike up above anything that crude has hit in the previous couple months, and that will remain higher than anywhere it hits in for a month or two after that. So the in-between trends are dictated more by short-term indicators and price patterns, but I would be looking for another significant peak in late February, early March, before it has a chance for maybe even a larger corrective period.
Cryptocurrencies, do they follow the cycles?
Bitcoin has been surprisingly precise in not only cycles but technical indicators. I've actually gotten a lot of added interest and involvement in my services after the last few months analysis, where I described how the wave structure and the cycles and many of these extreme price indicators that I watch were first telling you when we sold off into June that the market had one more leg up. It should spike up to 66 to 68,000 in Bitcoin, and late October, early November was when intermediate cycles were next peaking, and we did exactly that, retested the highs, spiked a little bit above them, and when I was hearing many readers say, okay, we're going over 100,000 now, I said, well, all of my work tells me that's a peak that's going to hold for quite some time, and it's going to drive an initial correction down to about 42,000, and depending on how and when that level is hit, there could be even another leg down after some consolidation. Well, just in the last week, in the cash trading a week ago, Bitcoin spiked down to 42,000, shocking many of these traders who were trying to convince me that it had to go above 100,000. And I think that we're going to see some consolidation with that 40 to 42,000 as a floor. And right now there's some short-term resistance around 53,000 in Bitcoin. But again, there is a pretty decent chance that if price action evolves the way I think it could over the next few weeks, that Bitcoin could ultimately see another drop to an even more significant downside level, and that's one of the things that I've explained in some of my recent reports. And again, illustrated why I believe this. It's not just throwing opinions around. I try to, every issue of my publication, I believe in the old adage of not just giving a man fish, but teaching him how to fish. I try to make my publications educational, try to explain these cycles and technicals and why they work the way they work and what they're reflecting, not just lines on a chart, but kind of like a doctor who's looking at, results from an EKG or an EEG. Okay, all he's seeing is lines on a piece of paper. But that doesn't mean that he's diagnosing someone based on some scribbly lines. He's diagnosing them based on what those lines represent, what they are revealing. And it's the same thing with technical analysis of cycles. So I do try to really educate my readers, and so that they can understand it better, because that also gives a higher confidence level in many of these conclusions that we're discussing right now.
Eric, before we go, can you maybe tell people a little bit about InsideTrackTrading.com?
Well, I think that a good synopsis of it was the last 60 seconds, but we do provide analysis and trading strategies on the financial markets, although even that might be a misnomer because it spreads into many commodity markets, grains and precious metals, but providing not only analysis and trading strategies, but attempting to teach in each issue how these indicators work, why they work, with most of our newer subscription packages. We also offer a 100-page technical trading manual where I've put together many of the indicators that I've used for 30 plus years, 40 years even, and start that educational process right from the beginning. And even on our website, on InsideTrackTrading.com, there are sections on the website that also feature some of those indicators and give a little bit of tidbits of what we provide to our subscribers.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim.
My guest has been Eric Haddock, CEO and President of InsideTrackTrading.com, Inside spelled INSIIDE. He was speaking to us from near the Fresno area of California. Our conversation took place on December 16th. Coming up, Ray Merriman, next on This Week in Money.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Ray Merriman. He's the founder of Merriman Market Analyst and the author of several books on the correlation between market cycles and planetary cycles. His website, MMAcycles.com. He's speaking to us from beautiful Scottsdale, Arizona. Ray, welcome back to This Week in Money.
Thank you. Thanks for having me. Pleasure to be with you, Jim.
Ray, the Merriman Market Analyst will be starting its 40th year in the new year. Can you tell us about your letter and how people can subscribe and what's behind it all?
It's aging me a bit, isn't it?
Yeah, 40 years.
Students call me today and tell me that he's about to celebrate his 40th birthday. And here it is, I'm celebrating my 40th anniversary of this cycles report. Anyway, our flagship report is the monthly MMA Cycles report. It started in 1982. Now, it started off as a gold market newsletter because, I was working with Walter Bressert at the time. He was a famous gold market cycles analyst, Foundation for the Study of Cycles. And he had brought me on board to do a research study on the correlation between gold market and gold prices and geocosmic factors. And so I did that, and I loved doing it. The book got published. It brought me onto a national stage with the Financial News Network. And so I started with the gold market newsletter following the writing of the gold book in 1982. And it wasn't long after that the subscribers wanted information on silver, understandable. And then they wanted stock market. Then it went to crude oil, then currencies and grains. And as it stands today, we cover stock indices, especially the S&P and the Dow, gold, silver, euro currency, T-notes, crude oil, and soybeans. And the thing I think that people like most about our monthly report is our CRDs, our Geocosmic Critical Reversal dates, that apply to all those markets, plus our solar lunar short-term reversal dates for the Dow, gold, and silver. So most of our subscribers are independent traders. I mean, we have a few brokerage houses and back-end structures of the banking community that'll subscribe to our letters, but most of our subscribers are independent traders, and they like it that way, and I like it that way too. So now, in addition to our monthly report, which started 40 years ago, about 5 years after that, the demand was great to start doing a weekly and daily market report for active traders. So that's been going extremely well too for 35 years. Now, as far as finding out more about these reports, listeners can go to our website that you just mentioned, MMAcycles.com, and there they can find out about the reports. They can find out about other services we offer, books that I've written and published, or my students have written and we publish, software, educational programs, free articles that are interesting on the website, and much, much more. So, yeah, www.MMAcycles.com is where they can log into and read more about us.
Ray, your annual forecast, of course, is out now for 2022. Can you tell us a bit about it and how people can get a copy of it?
Yes, this will be our 45th year of publishing the annual forecast book. That goes back 1976. And it is available in German, Chinese, and Japanese translation too. It's a 200-page book, covers my outlook on social, political, economic, and financial markets for the next year based on cyclical and geocosmic studies. So, for instance, this year's book describes the turn from extremism in social, political, and economic thought more toward a path of moderation over the next remainder of this decade, actually. And you're going to see more elections where moderate candidates are going to win, and the extremist candidates, I think, aren't going to win, which is a good sign because we're going to move more toward common sense and away from socially and politically divisive rhetoric that has at least divided our country. I don't know how it is in Canada, but our country's been pretty divisive in the last, I would say, 12 years or so, maybe even going back the whole part of this century. Anyway, this movement toward moderation is based on what we call the waxing phase of Jupiter and Saturn. Now, they came together. It's a 20-year cycle. They came together 1 year ago, December 21st, 2021. And now they're starting to part ways, and they'll continue separating from each other for the next 10 years. And that's the time where the path of moderation, moderated behaviors and activities and policies lead to success. But it's also the time where, if you have extremists, radical thoughts continuing at that time, then you get problems. If you go back and look after every Jupiter-Saturn conjunction, within 1 to 2 years after that, you had a stock market, I would say, crisis, maybe even collapse. I mean, there's been severe downturns. For instance, the last time it happened was in May of 2000, the last time we had this aspect. And we went from very liberal thought to more conservative thought. But within the first 2 years of that, we had the dot-com bubble burst, and the market lost 40%. You go back before that, it was 1980, and that was, of course, the big inflation period. Stock markets, they dropped about 25% during that period. And you keep on going back, and you see these extreme things happening. But anyway, this movement toward moderation shown by Jupiter-Saturn, which was supposed to start in 2021, had trouble getting off the ground because we also had at the same time in 2021 the radical and extremist nature of the 11.25-year quarter cycle of Saturn-Uranus. And whenever you got Uranus involved, you get radical thought, revolutionary thought, extremism thought, and you get disturbances in society, disruptions in society and economics and financial markets. Anyway, that dominated all of 2021 and interrupted the moderation cycle of Jupiter-Saturn. Still, you saw some aspects of moderation come up in our elections in November where moderate candidates won and extremist candidates didn't win. I think you'll see that in 2022 also. The moderate candidates win and the extremist candidates don't win. So that cycle of rebellion in radical thought of Saturn and Uranus, it ends December 24th. And at least begins to gradually recede. Now, it may take 9 to 15 months to see it really become apparent that radicalism is becoming less dominant, moderation becoming more dominant, because those two planets will come back within 1 degree next September and October, just in time for our midterm elections. But I think it's even weaker than we saw in 2021. Now, in addition to what we described with the economy and interest rates over the next year, well, in addition to what I just said, I'm going to cover the economy, interest rates, and project, our outlook based on the studies that I do for the remainder of this decade, and show why interest rates are going to begin to rise. They've already started. This was in 2021. They started. And it's going to continue. It's going to continue for 30 years. We're not going to see these, I don't think we'll see these rates again in our lifetime. Well, maybe if you're young, but if you're my age, you're not going to see them again in your lifetime. So I'm going to cover the inflation cycle in this book, when the run-up is due to end, when I think from these studies the next recession is going to occur. These are just some of the topics covered in this year's forecast book, in addition to the outlook for stock markets, metals, currencies, Bitcoin, treasuries, crude oil, grains, and weather. And the back part of the book contains a calendar where every day it shows what the geocosmic signatures are, where the moon is each day. Readers love that, and it goes from January 22. The calendar goes from January 22 through April of 2023. So the book is nearly sold out. We nearly sold out. We only print an extra 20% after a cutoff date after the cutoff date with the pre-publication special. So that ended December 9th. So whatever we had at that point, we published another 20%. They usually sell out by March, oftentimes sooner. The cost is $55 plus postage, or no postage if you want an ebook fashion. And again, you can order it through MMAcycles.com, or you can call us at 1-800-MMA. Well, let's go back here. Let's say call us at 248-626-3034. That's a more reliable number. Or you can email us at customerservice@MMAcycles.com.
What is the Merriman Market Analyst Academy?
Well, the Merriman Market Analyst Timing, MMTA, the Merriman Market Timing Academy, is a 2-year rigorous educational program on how to understand and apply our market timing tools. It's a training program for those who want to become excellent market analysts, market timers, and traders, if that's where your skill set and psychological, appetite lies. In all, there's 100 classes. It's taught in 2 to 3 hour segments, live on Saturday mornings, Mountain Standard Time, to those who enroll. The classes are recorded because many of our people are, live in Australia or India or even China, Japan. So it's hard for them to meet at, noon our time, because that's midnight their time. So we record it, and everybody can draw down the recording. It's made available to them the following Monday. Each class comes with a PowerPoint slide, the recording, 100 to 150 page workbook for each of the 8 courses. So there's 8 courses, 6 classes in each course. Each course lasts 6 weeks, followed by a 6-week break, and all other courses and the entire courses are completed in 2 years. And those who take all the courses pass all the exams after each course, and do a research paper based on the principles taught each course to demonstrate their skills understanding these methods, they get a certificate of completion. And in many cases, we end up hiring them as analysts at MMA. So the thing to understand is, as you probably know, Jim, trading and analyzing markets is not easy. It requires rules, discipline to follow the rules, and time committed to develop your trading plan for the day, for the week, for the month. So we train students to become excellent analysts and researchers and market timers. And in many cases, if that's where their appetite is, exceptional traders. But I've got to say that some people are not emotionally or psychologically cut out to be traders because it's very demanding and their appetite for risk may not be appropriate to be a trader. But many of those people still become excellent analysts through this course. So that's what we do at MMTA, the Merriman Market Timing Academy. And they can find out more about that, too, on our website under the education menu item.
Right now, is it really right to call this financial astrology, or should we use the term Geo-Cosmic? Because astrology makes it sound like stars influence us.
Yeah.
Yeah, well, some of them don't
problem.
even exist anymore. The light we're seeing is billions of years old, whereas the planets are in planetary or solar terms right next door.
Yeah, it's easier, I think, for the public based on the history of the word of astrology in the last 3 or 4 sentences to probably use the term geocosmic or planetary studies, because that's what we're looking at. We're looking at cycles in planets or in their orbit around the sun. We're not concerned so much with the signs, Aries, Taurus, Gemini. I don't think the signs, the constellations I think they have very little influence, if any, on what's going on. It's the relationship of planets to one another and relationship to our seasons, to our equinoxes and our solstices. That's what's important. And we can show studies, we can show quantitative studies that show the correlation between those movements of the planets to one another, or in reference to the equinoxes and the solstices, to significant highs and lows in financial markets that we call reversals. So probably the word geocosmic is probably more accurate than astrology, because astrology is misunderstood and tends to apply science, and we're not focused on science.
In the past, have you seen connections between geocosmic relations and the markets?
Oh yeah, every day I see them. You have 10 planets, including the sun, that can form 6 different aspects to one another. So that's a lot of different possibilities right there. And then you've got the sun-moon combination, the solar-lunar cycle that forms. Those things form 144 different combinations throughout the year. So, and some of these, not all of them, some of these have a really high correlation to cycles we call major cycles, which are 6-week cycles, or primary cycles, which are 18-week cycles. A lot of them have very strong correlations to those cycles. If you give it about, a 3-day orb either side of where these combinations are centered. So yeah, there's quite a correlation, I think, between geocosmics and financial markets.
Right. So you said 10 planets, but really 10 celestial objects then that are influencing us.
Planets that include the sun. Yeah, you got 9 planets and the sun.
Yeah.
Yeah.
And you include Pluto as a planet. I like that. That's the way I was taught, and I still think it is. Because it's big enough to have its own moons.
Well,
if that's your definition of a planet.
The sun, it has a regular orbit.
Yeah.
The only problem is it's not a circular orbit. That's interesting, because it's kind of like the outlier of our solar system. It doesn't go in a circular orbit around the sun. There's certain times when it's very slow going through the signs, if you will, and other times it goes through them very quickly because it's an elliptical orbit. But I do call it a planet. It has an orbit and has a mass and a gravitational field and moon.
Mm-hmm. So are there a lot of different cycles in financial geocosmic time?
Are there a lot of cycles? Say that again.
Well, I think you actually explained to us whether you said 440 combinations in a year. So I have a feeling there's a lot of cycles, but do you know how many cycles there are when you use financial geocosmics?
Well, okay, so the sun and moon form 144 combinations a year, just them by themselves, without the planets. Just the sun moving every 30 degrees away from the moon, moving every 30 degrees away from the sun forms an aspect. So you get 144 of those combinations. And of those, probably, I would say maybe 20 or 25 in a given year have a 20% or greater correlation than the norm to reversals. When we talk about the stock market, we usually like to give a 4% reversal signature. So 20, 25 of those will have a correlation. It's 20% or greater than the norm expectation to a 1 to 4 day reversal that the market will move, let's say 2.5 to 4% or more. That's pretty good. Now, if you look at the planetary combinations, there are, I would say, maybe about the same, about 20 or 25 combinations. They only occur once a year, and you have to give them a bigger orb. You have to give them a 3-day orb. And they also have a correlation to what we call major or primary cycle tops or bottoms. I would say the probability is 2 out of 3 that the yearly high or low in almost any market will happen when one of these 17 to 20 combinations occur between planets. That 2/3 of the time they will correlate with the high or low of the year in any given market. Sometimes it'll be 100%. But, I think on the safe side, you can say it's 50% at least, and usually about 2 out of 3 times. The higher the low of the year of a treasury market, a currency market, a metals market, a stock market is going to occur. For instance, this Saturn-Uranus I talked about, that's the biggest cycle in effect in 2021. It happens 3 times. It happens February 17th. It happened June 14th. And it's going to happen December 24th. Well, if you go and look at the Chinese market, stock market, the Nikkei stock market, February 17th, 18th, that's the high. That's a multi-year high in those markets. In Japan, they had their highest price in 31 years on February 16th, 1 day before that first passage. China had its highest price in, I think, 5 or 6 years, 1 day after that, February 18th. Then the next one, June 14th, within a couple of days, that was also a primary cycle high in the Chinese market. And now you got this coming up again, December 24th, and we're having another rally, okay, that started, last week, December 1st to 3rd, which was a Geocosmic critical reversal day. You're having another rally. And it may not be that tight. It may not be within 1 day like it was the first 2 times, but we can give this a 2-week orb because of such a long planetary aspect. So I think, within 2 weeks of December 24th, 27th in that period, it's the weekend, you're going to see either a high or a secondary high in many markets and, a big reversal from there. So we'll see how that works, but that's what these things are projecting, and they have about at least a 2 out of 3 probability of occurrence, rate of frequency of occurrence in history.
Are we in an important geocosmic time right now?
Bingo. Right now, December 24th to 27th, give or take 2 weeks. It's one of the 3 biggest ones of the year.
Do you have price targets and time frames for the Dow?
Well, the time frame for the Dow, it's actually December, give or take 1 month. You have to give it a broad range. But even within that period, that December 24th to 27th, give or take about 2 weeks, is that's the sweet spot of this November to January period when you look for a top and a decline. Now, this would be, we call it the 23-month cycle. You have a 4-year cycle in the stock market. The half cycle is 23 months. And you start with the bottom we had in March of 2020. So 23 months later takes you to February 2022. And it has about a 4-month orb. So, yeah, somewhere in this period, you're due for that 23-month cycle low within 4 months of February. Okay, I happen to think it's going to happen by the end of March, but technically it could go out till June or July even. And it should be the steepest decline since the pandemic crisis low we had in March. That was 38% in the Dow. So it won't be that big, but it'll be the biggest one since then, and the biggest one since then so far has been 10%. So my estimate is we could see an 11 to 19% decline from the high that's forming within a month of December, and I think it'll be done by July and probably done by March. So, that would take you back down to, 10% would take you from 3,600, 36,000, 10% would be 3,600 points. If it's closer to 20%, it'd be 7,000 points in the high. So let's say 29,000 to 33,000 would be the ideal target for the Dow to make a bottom, and then I think that's a good buy point.
The IMF met with 10 countries to simulate a cyber attack on the global financial system last week. Back in 2019, Event 201 simulated a global pandemic, and surprise, a month later, COVID showed up. Is financial geocosmetology able to see anything on the horizon to do with the global financial system?
Well, the way I'd look at that, Jim, is that, the central banks and the various governments of the world, they have been more intrusive, more interfering, and getting involved in, I hate to use the word, but I don't know a better word, in manipulating the market, especially the interest rate markets. Started in 1987, 88 after the great crash we had, the stock market crash of Black Monday, but it's really picked up in 2008 with the innovation, experimentation of things like zero interest rate policies, quantitative easing. All of these have been very intrusive and contradictory to the concept of free markets and free market economies. It's been manipulated. That Pluto moved into Capricorn, which is coercion and interference and active involvement and trying to manipulate prices. Pluto went into Capricorn 2008. It ends in 2024. So even though they're starting to scale down now, that's probably because we're getting toward the end of that 16-year planetary cycle. And so when you do things like you just mentioned here, the Global Financial System Event 201 in 2019, they're doing it again now. It's not over. It doesn't end. It could go on for another 3 or 4 years. And as far as how it affects the market, that fits right into the idea of the 23-month cycle low coming up sometime in the first half of next year. So this experimentation they did in 2019 led to a big decline. They're doing it again. I don't think the decline will be more than half of what it was then, but I think there is a decline coming up. Maybe it relates to that. I don't know, but I really don't think this idea of, market intrusion, interference, is really good in the long end, because I do think there's going to be a consequence to pay for it, and we're going to see that consequence. And we're going to see that consequence, I believe, in 2025 to 2029. That's when I see the next big recession like we had in 2008, 2010 area.
Could we be in the midst of a repeat of 1929 to 1932, this time starting in 2020?
2020?
Yeah, have we already started the 1930s crash?
Well, the aspects we had in 2020 are similar to what we had in 1930 to 1931. And, we had the market topped out a little before that, topped out in September of 1929. And, you saw the same thing with Black Monday 1987, the big aspects that were similar to the Great Depression then and similar to 2020. They began in February of 1988, but the crash was 4 months earlier. The high was 5 months earlier, 6 months earlier. So when you get these kinds of aspects, the high usually comes before the aspects begin or right at the end of the aspects. Well, the aspect ends this month. So sometime between 2020 and 2021 is one of those heavily populated outer planet aspect periods. Not only that, all the outer planets are very narrowly placed in the heavens right now. They're all within 1/3 of the 360-degree circle of our universe, as seen from Earth. They're all within 1/3 of that, in 120 degrees. And as Andre Barbault wrote in 2012, when that happens, you get economic disturbance and pandemics. He nailed it in 2012. by just that method. When the planets come together in a tight orbit like that within 110 degrees, he had 110. It was actually down to 100. You get major disturbances in the economy, politics, and health matters, pandemics. So we're coming out of that. We won't be out of that really until 2024, 2025. So this could be the top. I mean, I got a cycle that says it could be a top. It could even last till 2024. But what is most clear is that the eclipse cycle, the 18.5-year cycle, comes due again in 2026 to 2029, which is why I'm saying that 2025, 2029, that 18.5-year cycle, is probably, in my opinion, where the next depression or recession happens related to the nodal cycle following the tight orb of all of those outer planets between 2020 and 2024, and especially 2020 and 2021. That period, 2020 to 2024, 2020 to 2021, would historically have the highest probability from my studies of correlating with the long-term cycle crest, followed by a big decline. How big a decline? Well, that decline could be as much as one we had before, which is 38%. In fact, you know, these things are usually about 37% to 50%. So whatever our high is, I think we're going to get a lot of that shaved off by the time we get to low in 2026, 2029, which I would advise listeners to think of as the greatest buying opportunity we have coming up in the rest of this decade. That's your bargain basement time. If you get back involved in the market, if you get out during this time.
Mm-hmm. Is inflation the big story?
Yeah, it's the biggest story right now. It's a big one right now, and I wouldn't be surprised if we see double-digit inflation by the spring, but I do see it moderating after spring. You know, April 12th, we have Jupiter, which is exaggeration expansion, in the sign of Pisces with Neptune. Neptune rules Pisces. So Jupiter's with Neptune, and Neptune is loss of control, so this is a very inflationary combination. You know, it started when Jupiter went into Pisces for a brief period for 2 months, from May 13th to July 28th last year. 2021. We're still in it. So May to July last year is when it started raising its head. Up until then, nobody's concerned with inflation prior to May. Suddenly in May and June, they started saying, this looks like we may be getting inflation. And now it's becoming the big story of the day. And it's not going to go away. I don't think it's going to go away before April, May. And I don't know if it goes away then. It just moderates then. The rush, the surge is going on now through May. And I wouldn't be surprised if we see, we're almost there now, a producer price index. It's 9.7%? And consumer inflation 6.8% in the U.S. I think they could both be in double digits in the next, 4 or 5 months. It's a big story.
Is inflation usually bullish for stocks?
Stock? No, not for stocks. It usually indicates a time of stagflation. Markets, they usually put in their high as you go into it. Now back up a second. Inflation usually begins with the stock market. You usually get asset inflation. And my God, we've had that since 2009. We've been in asset inflation. So that's been going on, but it hasn't affected the prices of the goods we pay that severely as it has been since May. Now we're getting, triple the inflation rate of which the Fed predicted. They thought we'd get to 2%, maybe a little over. I mean, that was an error of epic proportions to miss it by that much. But they did. They missed it. Oftentimes they are behind the curve. This is another example when they got behind the curve. But I've also got to say that many times they've been right too, but this is one of those times they haven't been right. And as far as stock markets, it's usually the stock market will top out ahead of them, then it usually goes into about a 20% range, up and down 20% sideways. That's what we call stagflation. Prices are high, so when you get prices high, if the wages aren't keeping up with it, then people can't afford to buy as much. They start saving their money because they're starting to get some return on their investment for savings, and they don't have to speculate in the stock market, so you get less buyers of stock, more buyers of treasuries and short-term interest rate vehicles. Those kinds of things, they're not necessarily bad for stocks, but they're not good for stocks. The stagflation goes into a long period of congestion. And then, but still at some point, I do think when we get to the middle of the decade, to the end of the last half of the decade, I think there will be problems. I think it may go more than 20%. I think you may be looking at, as I said before, 30.5% to 50% decline from the all-time high during that period.
Do inflationary cycles tend to coincide with cycles in gold and silver?
Yeah, they tend to be very good for gold and silver. People tend to think of gold and silver as inflation hedge. When inflation is going up modestly, no, it's not that important because the central bank raising interest rates, which supports the U.S. dollar, and that's a deterrent to the price of gold and silver. But at some point, if it starts getting into double-digit inflations and hysteria comes into the market, people will start saying, well, what's the use of having paper fiat currency? You know, it's not going to grow as much as inflationary sensitive instruments like gold and silver. So people start looking at gold and silver more and using that as an inflation hedge.
What do geocosmic events see ahead for the U.S. dollar?
Well, I think it's bullish until 2024. And that's a headwind for gold, but like I say, if inflation gets to double digits, it won't matter. They'll still buy gold even with interest rates going up. But this is based on two things. One, a Saturn-Pluto cycle. That happened with the pandemic. That was in middle January 2020. And it was the first case of COVID was reported November of 2019, but the people didn't take it seriously till February of 2020. That's when the stock market started crashing. But Saturn-Pluto is also, within a year, is usually time at the bottom of interest rates. Well, when it's a conjunction, it's the bottom or the top. It's a 32 to 37 year cycle. So 2020 was that, and it's a bottom. You go back 32, 37 years before, that was 1981, 82. That was the previous Saturn-Pluto. That was the top, the all-time top. And if you go back 32, 37 years before that, it was 1946, 47. That was also when interest rates were maybe 0.25%. That was a low. So every other cycle, it rotates from a low to a high to a low. We're having a low now. The next one will be a high. That's in 32 to 37 years, the beginning of the decade of the 2050s. So we're going up until then. But initially you go up slowly. It's gradually. The first decade, which is now, it's not that steep. It's a moderate gain, a moderate increase in interest rates, which supports the U.S. dollar. So I think the U.S. dollar probably looks good. The other part of the U.S. dollar that looks good is its correlation with the political party in office. When a Democrat is president in the United States, the dollar goes up. When a Republican is a president, the dollar goes down. And you can go back and look every 16 years when we change offices like that. This was a kind of like out of the cycle that happened in 2020. I mean, that was, the cycle said the Republicans were due to win, but the Geocosmic said the Democrats would win. So the Republicans didn't get reelected, but the Democrats did. And instead of the dollar continuing to go down into 2024, which would favor the Democrats getting elected, a Democrat got elected in 2020, and now the dollar is going up. So I think it continues up to 2020, 24, and depending which party is elected will determine whether it continues up past that or starts coming down.
We keep hearing about real estate bubbles. Can Geo-Cosmetics tell us when the bubbles are going to burst?
Geocosmics?
Yeah.
Not cosmetics, cosmics, yes, okay.
Cosmeticals. So I don't know the right term for Geocosmics.
It's cosmic. We're talking about the cosmic lookout here. So, as interest rates go up, it affects real estate in two phases. When it first starts going up, you're going to get a rush of people trying to lock it in because they think it's going to continue going up. So even though it's going up, there will be more activity, more buying, which continues to support the bubble. But once you get through 2 or 3 interest rate hikes, it has the opposite effect. People stop buying. They don't want to take on the mortgage at that point. So I think you are going to see the real estate market top out in 2022 and start to come down. I don't think it's a serious decline though until you get to, when people don't have money, when the liquidity dries up. That's the important thing. And that liquidity is not going to really become a serious problem, I don't think, until after the next election, after 2024. So going into 2025, 2026. So if you're thinking about buying real estate, you might be able to get a good deal in the next year because I think there will be a little bit of a sideways action or pullback, a stop of this bubble. It'll pause. But But I think your better value, if you can wait to it, would be probably after 2026 to 2028. I think that's when when real estate prices come down, they don't stay down for long, 1 to 2 years maybe. So I don't think you're going to get one of those 1 to 2 year declines in real estate till you get to after the next election, 2025, 2028, that period.
Maybe you covered this. What do you see ahead for interest rates?
Going up. I think they're slowly going up.
Electric vehicles and the battery metals needed for them are relatively new markets. Can Geo-Cosmics account for them?
Yeah, they are the future, and they're going to continue increasing in value and demand right until, I think it's going to be for the next 20 years. Pluto is going to move into Aquarius in 2024, and Aquarius rules electricity and innovation, and it's one of the automotive signs. Gemini, Aquarius, Sagittarius, they all have to do with automotive, especially electrical vehicles. And as it goes into Aquarius in 2024 or 2025, it's going to trine Uranus, which is a planet that rules electrical vehicles, space, truck, anything electrical, and transportation. So I think these cycles look really good till probably to 2024, 2025. And actually, I think they're going to look good for another 20, 30 years. However, in a recession, everything's going to come down. So I don't know if it comes down as much as the other markets, probably not, but I do think, all markets, including electrical vehicles, are going to have a challenge when we get to 2025, 2029. But up until then, I think that is one place to be looking to be invested. I think electrical vehicles are a positive place to look to invest your monies, during the next 4 years.
What do you see ahead for crude?
I think crude oil is going to get to $90 a barrel by the end of spring, early summer. I think crude oil is going up. So I like this idea of crude in the low 60s. Now it's in low 70s. That may have been the bottom. But you're trying to put in a 17-month cycle low. That could have been in the low 60s, made a double bottom there. And now I think it's headed up 50% from that. I think going to the 90s, maybe higher by the time we get to summer.
What do you see ahead for grains?
I think it's topped out. I think they topped out back in the spring and early summer when soybeans got to 1670s, and corn got, I'd have to go look, close to $6 or something. Anyway, that was the time for the top. And 2020, 2021 was the time for the top in grain. So I think they pull back here. The biggest threat to my idea that the pulling back in price and the biggest threat to the planting season is going to be rains. Jupiter in Pisces and Jupiter conjunct Neptune is an abundance of rainfall. And that's between December 29th and May 10th, and especially within a month of April 12th when Jupiter hits Neptune. So that's getting into planting season. If the ground is too wet to plant corn, then you may find farmers moving into soybeans. So you could get a bounce in corn. If there's any grain I'd be looking at, probably the ones that are due to be planted in April. I think they're going to be delayed due to rains in the grain belt. So I'm not extremely bullish on it, thinking it's going to make a new high. But whatever low you get going into spring, I think you could buy that February, March, and try to hold it until you get to at least April, May. In anticipation of a heavy rainfall and floods, which could delay the planting season and hence support grain prices during that time.
What do you see ahead for Bitcoin?
I think Bitcoin is still gonna. It's like some of these other markets. It's like crude oil to me. I think Bitcoin could get to 90,000. Like crude can get to 90 barrel. I think Bitcoin can get to 90,000. It's got to get back above 60,000. But I think you got good support here between 40,000 and 50,000. It's kind of been, finding support back and forth between 45,000 and 50,000 on Bitcoin. It needs to get some momentum, but you are due for a bottom. You're actually due for a bottom now. Last week through the holiday season, you're due for a bottom. And if it can hold the 40,000 area, in fact, it got down to 41,000 on December 1st, I think, around that time. To me, that's the low. But if it can hold that, in the next couple of weeks and then start taking out 52, 53,000 and then 60,000, I think you're on your way to this speculative frenzy coinciding with Jupiter conjunct Neptune in Pisces, April 12th, give or take a month. And I think by that time you could see Bitcoin, approaching six digits, approaching, 100,000, 90,000, 100,000, I think is possible. But once you get to that top, and I think the top is in this year, 2022, then I think Bitcoin before the end of 2023 is going to have a 70 to 95% decline. I'm not sure what caused it. Probably governments starting to, talk about regulating it, getting it into a consistent price range so people can see it as a stable currency. But it's volatile, so my estimate is that you're going to see Bitcoin get to 90,000, 100,000 and then drop back down under 30,000, all within the next 18 months.
Is COVID-19 part of a disease cycle?
That's hard to say. I did a study on not COVID-19, but on pandemics. And what I found was that in 80% of the deadliest pandemics in world history, you had an aspect of Saturn and Neptune, a hard aspect, conjunctions, oppositions, squares. Which, that's not unusual. Things happen every 9 years. But to find that 80% of the pandemics occurred with effect, and we have an aspect in effect now. And it actually ends this month in December. Maybe it spills over into January. So I would think COVID-19 becomes less and less a worry as we go into the spring, even in the end of the winter. I think it's less and less a concern. But as far as being part of a disease cycle, Saturn, Neptune, the biggest aspect of that comes up February 20th, 2026. That's the aspect that correlates with, the probability, a higher possibility, I should say, of a disease cycle. So the fact that we're not getting rid of it, that it's still with us, and it keeps mutating, if it doesn't end, I would say if it doesn't end by the end of spring of this year, it's going to be with us and have another escalation point in 2026, February 2026, give or take a year there. So it could be part of a disease cycle. I don't know for sure, but it could be because you got that aspect that's correlated with the pandemics in the past coming up again in 2026.
What do Geocosmics see ahead for China?
Well, actually, China's growing. Yes, I know they're having a pullback right now, but the Jupiter-Saturn cycle in we call air signs, which is the first time an air signs has happened in 800 years. You've got to go back to 1200s to 1400s to see the cycles every 20 years be in air signs. They go for 200 years in certain elements and they shift elements. Well, that happened December 21st, 2000. And that tends to move the emphasis in favor, I think it's more in favor of China. China's history tends to do well when Jupiter and Saturn are happening in air signs. When it's in earth signs, which the last 100 years, it favors centralized governments, democracies, people having a voice in their government. But when you start going to air signs, that's not the emphasis. Central governments and local governments and organizations and businesses, all that tends to become less and less important. What becomes more important is culture, intellectual, artistic development. And for some reason, China does well in those cycles. I don't know what the United States would be because we haven't been in that cycle before in the United States. We're only, 250 years old, and this cycle goes back 800 years. But we can go back 800 years and see China did very well in those cycles.
China goes back 5,000 years.
Yeah, well.
They have a bit of history there.
Goes back 800 years, but China goes back 5,000. It's had several of these cycles and go back and see they've done well in them.
Yeah. Ray, how can people find out more about the Merriman Market Analyst?
Well, they can call us at, again, 1-800-MMA-3349 or 248-626-3034. Or they go to our website, www.mmacycles.com, or they can email us at customerservice@mmacycles.com. And we love to hear from them, and we hope they enjoy this program, and we'll check out our website.
My guest has been Ray Merriman, publisher of the Merriman Market Analyst on MMAcycles.com. He was speaking to us from Scottsdale, Arizona. Our conversation took place on December 16th. And that wraps up our show for this week. We'd like to thank our guests, Bob Hoye, Eric Haddock, Ray Merriman, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@howestreet.com. Now stand by for a company showcase update from American Manganese CTO Zarko Meseldzija. I'm Jim Goddard. I'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. Usually we'd be talking to CEO and president of American Manganese, Larry Ray, right now, but instead he's handed the reins over to CTO and director of American Manganese, Zarko Meseldzija. And Zarko's here to talk about a news release that came out this week for American Manganese and also explain some of the technical aspects. And of course, that's your specialty, getting into the technical stuff. So welcome to Company Showcase, Zarko.
Thank you for having me.
What can you tell us about the news release?
Well, first I want to say, Larry has kindly asked me to take his place for this week's podcast and give that insight on the technical aspects of our RecycLiCo process and our vision for American Manganese. So I want to first start off and say that I have a tremendous amount of respect for Larry because it's his market knowledge, focus, and drive to tackle new challenges that have positioned American Manganese as a battery recycling pioneer today. He's always made himself patiently available with daily emails, calls, and these weekly podcasts to discuss current and short-term market fluctuations. But today I ask for listeners to consider the bigger picture and how the company's business model fits into a long-term strategy and why I remain focused and optimistic. So, I don't think I even need to argue this point anymore, but we are in a global shift to electrify everything, and recycling batteries will be inevitable. But the electric vehicle market hasn't even left the driveway, and there are no GPS directions to the recycling center. Only backseat drivers trying to point the way, and we're all learning along the way. Now, over the past few years, I've read a lot of R&D news in the battery and EV space, such as next-generation batteries that aim to improve legacy technologies with an increased range or reduced charge time. But when it comes to recycling, we're often asked, are the batteries recycled? Yes or no. But, how is the word recycling even defined now? For example, when it comes to an end-of-life battery, naturally, you would have the collection of the whole battery pack, and then that pack would undergo mechanical size reduction, known as shredding, and that would form, commonly known black mass, and then that black mass would undergo a chemical treatment known as hydrometallurgy to recover the valuable materials and produce a usable product. However, I've seen all of these stages defined as recycling, and it can get complicated when quoting recovery rates or processing capacity. For RecycLiCo, we define our recycling process on the hydrometallurgical stage. But hydrometallurgy is a broad term, and yes, other hydrometallurgical processes and recycling methods do exist, and no, they're not the same as RecycLiCo or at the same scale. I do also read the headline news, but what I like to do more is read the detailed technical papers on battery research and consult with a fantastic team of scientists and engineers at Commodities. And this keeps us aligned on our process benefits and mission. We look at the practicality of a process, such as its scale, its complete flow sheet mass balance, the chemicals used, extraction efficiency, and the product that comes out at the end. What is the value of that product? And if you've been following our company, you then know that we don't just recycle, which is breaking down the materials into individual components, but we also upcycle, which is creating more value out of the input material, such as a high-purity lithium compound, and finely tuned cathode precursor materials. This has its benefits, especially in today's complex and linear supply chain, because the mined and recycled materials all really end up getting shipped overseas to be refined into cathode materials. So there's even more benefit in the recycling and upcycling when you layer on top of the rising lithium prices, the battery material shortages, and the new policies advocating for, the reshoring of industries across the whole battery value chain. So, I'll get to your question. Hopefully I've cleared the air a little bit, but now I'll recap this week's press release and explain some of the logic behind our company's business model. So on December 14th, we provided an update on the advancement of our demonstration plant project for the hydrometallurgical battery recycling and upcycling. And this is on track to start operation in February 2022. The facility will be a 6,700 square foot facility in the Greater Vancouver area, and it will be prepared and is taking delivery of equipment for the designed processing capacity of 500 kilograms per day of cathode waste. Now, don't confuse the 500 kilograms per day of cathode waste with the commonly quoted mechanical shredding capacity of whole lithium-ion battery packs, which is, much heavier. And so, one thing we actually often get asked is, why a demonstration plant and not a commercial plant? Well, our business model is to license and joint venture our RecycLiCo process to battery and EV manufacturers to establish almost like a recycling corner alongside their existing footprint, and as a technology partner. And this is different than having a standalone commercial facility that imports waste from multiple sources, because our market analysis tells us that battery and EV manufacturers will want more ownership of their waste material to completely close the loop on their supply chain, and also recover maximum value, reduce transportation-related emissions, and adhere to increasing legislation that's focused around that extended producer responsibility, so putting more of the ownership on them. But with this, there's a gap in hydrometallurgical recycling and upcycling, and especially the know-how. So there's a gap there, and we've been fortunate to have been studying, optimizing, and scaling our RecycLiCo process since 2016, which puts us, at a great advantage. And then the demonstration plant is a tool or platform to demonstrate real-world operating conditions to potential strategic partners and collect the engineering data, design data, and provide bulk samples of products to third parties for process and material validation. We would, with the demonstration plant, I guess, further de-risk our process from this at this scale, and with that aim to work with strategic partners to design and implement multiple commercial operations in-house. Now, I will be honest, though, and say that these conversations do not happen overnight, but long-term, this is how we envision a proper closed-loop strategy, and why we need to cross our T's and dot our I's to ensure that we have a practical and efficient process. Now, in the short term, I understand there are lower quantities of waste batteries now that need to be dealt with, and there is a focus on getting supply contracts. But I like, comparing it to mining, and maybe some of you have heard me say this before, but because in mining you're sitting on your resource, and you've planned out your mine life for your hydrometallurgical process, or where that material is going to go to. But in recycling, the supply of waste batteries can unexpectedly run dry if the manufacturer were to shift to recycling their own waste stream. And this is really where the industry right now is kind of in limbo, and I don't think there is a clear definition of what will happen. But this is how we've calculated it out, and how we envision the future of the companies. So I hope you've enjoyed hearing from me on this week's podcast, and I'm always happy to come back on if that's what listeners want.
Zarko, can you tell us where the company is traded?
Yeah, the company is traded on the Toronto Venture Exchange under the ticker symbol AMY, on the OTCQB under AMYZF, and the Frankfurt Stock Exchange under 2AM.
And if people have questions or want to get more information about American Manganese, where should they go?
So our website is AmericanManganeseInc.com. Mine and Larry's email can be found on there, or you can call our office at 778-574-4444.
Zarko, thank you so much for the update.
Thanks, Jim.
My guest has been Zarko Meseldzija. He's the CTO and Director of American Manganese. I'm Jim Goddard. Our conversation took place on December 17th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.